Welcome, dear viewers. In today's investor news, we're talking about SPACs wiping out half of their value as investors lose appetite for risky growth stocks. SPACs, once Wall Street's hottest tickets, have become one of the most hated trades this year. The proprietary CNBC SPAC Post-Deal Index, which is composed of SPACs that have completed their mergers and taken their target companies public, has fallen nearly 50% this year. The loss has more than doubled the S&P 500's 2022 decline as the equity benchmark fell into a bear market. Before we get into detail about this news, don't forget to stay till the very end for a bonus fact. More on the news. Appetite for these speculative early-stage growth names with little earnings has diminished within the face of rising charges as nicely as elevated market volatility. In the meantime, a regulatory crackdown is drying up the pipeline as bankers began to reduce deal-making actions within the area. We consider SPACs might want to proceed to evolve as a way to overcome challenges, stated James Sweetman, Wells Fargo's senior world different funding strategist. Normal market volatility in 2022 and an unsure market surroundings leading to losses within the public markets have additionally dampened enthusiasm for SPACs. The most important laggards this 12 months within the area embody British online used automotive startup Cazoo, mining firm Core Scientific, and autonomous driving agency Aurora Innovation, which have all plunged to greater than 80% in 2022. SPACs stand for particular goal acquisition firms, which increase capital in an IPO and use the money to merge with a personal firm and take it public, normally within 2 years. Some high-profile transactions have additionally been nixed given the unfavorable market circumstances. Together with SeatGeek's $1.3 billion take care of Billy Bean's Red Ball Acquisition Corp. To understand what all this means, you need to know exactly what SPACs is and how it works. Number 1. What's a SPAC? A SPAC is a common alternative to the traditional initial public offering technique. SPACs are shell companies that have no business operations. You may be wondering why someone would create a company without real business operations. The sole purpose of a SPAC is to raise money to support the future acquisition of a target company. After a SPAC goes through an IPO, it puts the money it raised into an interest-bearing trust account. This account will remain untouched until the SPAC management team finds a private company to take public. SPACs are also known as blank check companies because investors don't know what the targeted acquisition will be. At Vanguard, clients may begin purchasing SPACs after the initial IPO, when the SPAC units begin trading on the secondary market. Number 2. A questionable start. When SPACs first appeared as blank check corporations in the 1980s, they were not well regulated, and as a result, they were plagued by penny stock fraud, costing investors more than $2 billion a year by the early 1990s. Congress stepped in to provide much-needed regulation, requiring, for example, that the proceeds of blank check IPOs be held in regulated escrow accounts and barring their use until the mergers were complete. With a new regulatory framework in place, blank check corporations were rebranded as SPACs. Number 3. Stakeholders. SPACs have 3 main stakeholder groups: sponsors, investors, and targets. Each has a unique set of concerns, needs, and perspectives. 1. Sponsors. The SPAC process is initiated by the sponsors. They invest risk capitals in the form of non-refundable payments to bankers, lawyers, and accountants to cover operating expenses. If sponsors fail to create a combination within 2 years, the SPAC must be dissolved and all funds returned to the original investors. The sponsors lose not only their risk capital, but also the non-insignificant investment of their own time. But if they succeed, they earn sponsors' shares in the combined corporations, often worth as much as 20% of the equity raised from original investors. 2. Investors. The vast majority of investments in SPACs to date have come from institutional investors, often highly specialized hedge funds. Original investors in a SPAC buy shares prior to the identification of the target company, and they have to trust sponsors who are not obligated to limit their targets to the size, valuation, industry, or geographic criteria that they outlined in their IPO materials. Investors receive 2 classes of securities: common common stock, which is typically at $10 per share, and warrants that allow them to buy shares in the future at a specified price, which is typically $11.50 per share. After the sponsor announces an agreement with a target, the original investor chooses to move forward with the deal or withdraw and receive their investment bank with interest. Number 3. Targets. Most SPAC targets are startup firms that have been through the venture capital process. Firms at this stage commonly consider several options: pursuing a traditional IPO, conducting a direct IPO listing, selling the business to another company or a private equity firm, or raising additional capital, typically from private equity firms, hedge funds, or other institutional investors. SPACs can be an attractive alternative to these late-round options. They are highly customizable and can address a variety of combination types. Although targets are commonly a single private company, sponsors may also use the structure to roll up multiple targets. SPACs can also take companies public in the United States that are already public overseas and even combine multiple SPACs to take one company public. 4. How SPACs trade. In a SPAC IPO, the company will typically issue tradable units instead of common shares. One SPAC unit equals one share of SPAC common stock plus one warrant or a fraction of a warrant. After a SPAC merger event is approved, SPAC units will automatically convert into common stock shares and warrants of the acquired company. It may take up to 2 days after the merger event to see your new shares and warrants online. Number 5. Warrants. Warrants give shareholders the right to purchase a certain number of shares of the company at a set price, known as the exercise or strike price, up until a specific date known as the expiration date. When a warrant redemption is issued, the holder may have a limited time to exercise their warrants before the SPAC company redeems all outstanding warrants for $0.01. Further information on a SPAC's warrant redemption process can be found in its prospectus. Number 6. Risks associated with SPACs. There are many risks related to investing in a SPAC. These include not knowing the SPAC's investment strategy during the initial IPO, having to rely on the SPAC's management team to find a suitable target company, being in the dark about the intended target company, recent regulatory scrutiny by the SEC, and dilution of SPAC share value due to compensation of the SPAC management team. Companies that go the traditional IPO route are subject to regulatory and investor scrutiny of their audited financial statements. Because of their structure, SPACs don't go through the traditional IPO process, and their success depends on the skill of the management team. Investing in SPACs carries unique risks, so it's important to evaluate whether a SPAC investment is a suitable choice for you. Before adding a SPAC to your investment portfolio, carefully read the SPAC's prospectus and consider the company's objectives and associated risks. The SEC has an investor education bulletin that discusses the risks associated with this investment. Number 7. Redemption rights. Before the merger event, SPAC shareholders are given the opportunity to redeem their shares from the SPAC's trust account at the IPO price, which is usually $10 plus accrued interest. This process is separate from the merger vote. If you're a SPAC shareholder and you wish to request a redemption, you must call our asset servicing team at least 2 business days before the redemption deadline. The deadline for redemption is stated in the SPAC proxy prospectus. And now it's time for the bonus fact. But before that, we would like to thank you for staying with us this far. One of the early and successful SPAC IPOs of this modern era was for human spaceflight company Virgin Galactic Holdings. The company went public in 2019 in partnership with Chamath Palihapitiya's original social capital Hedosophia SPAC. What are your thoughts on SPACs wiping out half of their value? Comment down below and let us know all about it. Thank you for staying throughout this video, dear viewers. Like, comment, and subscribe before leaving so you can get the latest news and updates so you can stay on top of the investor game. See you in the next video. Goodbye.